Hello, my respected teachers and my dear friends. Today we are going to discuss about the topic marginal costing. The objective of the study is to understand the basic concept of marginal cost and the marginal costing. Second, to understand the concept of contribution, PV ratio, EEP, break-even point, and margin of safety. Third point, to know the concept of cost volume profit, CVP analysis. Third slide, we are going to discuss about the topic marginal cost. Marginal cost is defined as the change in aggregate cost due to change in the volume of production by one unit. Marginal cost is the additional cost incurred in the production of one more unit of a good or service. It is derived from the variable cost of production, given that fixed cost do not change as output changes. Hence, no additional fixed cost is incurred in production in producing another units of goods or services once production has already started. Third, we are discuss about the layout of the marginal cost. First, we need direct material, that means sales. After that, we need to less with the variable cost, we will get contribution, and then we need to minus it less, we need to bear fixed cost, and then we will get the profit. Here we are discussing about direct material, direct labor, direct expense, prime cost, plus total valuable overhead, marginal cost per unit.
So let's talk about marginal costing. Marginal costing is the costing technique wherein the marginal cost, that is the variable cost, is charged to units of cost, while the fixed cost for the period is completely written off against the contribution. Ascertainment of cost and measuring the impact on profits of the change in the volume of output or the type of output. Marginal costing is very useful technique of decision making. In marginal costing, the costs are also segregated into fixed and variable. Now, we are going to discuss the features of marginal costing. Marginal costing is a technique of costing which is used to ascertain the marginal cost and to know the impact of variable cost on the volume of output. Selling price is based on marginal cost plus the contribution. Profit is calculated by deducting marginal cost and fixed cost from sales. The profitability of a product or department is based on contribution made available by each product or department. Cost volume profit or break even analysis is one of the integral parts of marginal costing. Valuation of stock of work in progress and finished goods is done based on the marginal cost. Now we are going to move on to the next slide. We have the advantages and the limitations of marginal costing. So let's start with the advantages. It is a simple to understand and easy to operate. It helps in the evaluation of the performance of different departments, divisions, products, and salesmen. It helps in cost control by concentrating on variable cost as the fixed cost is non-controllable in the short period. What are the limitations? The classification of total cost into fixed and variable cost is very difficult. In marginal costing, historical data is used while management decisions are always related to future events. It does not provide any standard for evaluation of performance. So now we are going to move on to the next slide. So here we have a format of income statement under marginal costing. So as you can see, we have sales in particulars where we deduct variable cost from sales and we get contribution. And we have to deduct the fixed cost from contribution and we will get the total profit. So this is how we calculate the total profit under marginal costing. Thank you.
Some concepts of marginal costing. Fixed cost. Fixed cost, known as period cost or time cost, does not depend on volume of production and sales. Fixed cost remains constant. Fixed costs are fixed in unit. Examples: salary, rent, manager salary, etc. Variable cost. Increase and decrease in proportion to sales and output, called as product cost or marginal cost. Varies in different proportion to output. Variable cost vary in total, but they remain constant per unit. Example: direct material, direct wages, etc. Next slide. Contribution. Contribution is the difference between sales and variable cost. Contribution is also known as contribution margin or gross margin. Formulas. Contribution is equals to sales minus variable cost. Contribution is equals to fixed cost plus profit. Contribution minus fixed cost is equals to profit. Contribution plus variable cost is equals to sales. Sales minus variable cost is equals to fixed cost plus profit or loss. Profit volume ratio. Profit volume ratio indicates a relationship between contribution and sales and is usually expressed in percentage. High P by V ratio indicates high profitability. Low P by V ratio indicates low profitability. Next slide, please. Here are for some formulas of P by V ratio. P by V ratio is equals to contribution by sales into 100, or it could be sales minus variable cost by sales into 100, or it could be fixed expenses plus profit by sales, or change in profits or contribution by change in sales into 100. Margin of safety. Margin of safety measures the distance between budgeted sales and break-even sales. Margin of safety is equals to actual sales minus break-even sales. Margin of safety could also be profit by PYV ratio. Thank you.
Break-even point. The break-even point can be defined as a point where total cost, expenses, and total sales revenue are equal. Break-even point can be described as a point where there is no net profit or loss. Total sales revenue is equal to total cost incurred. Formula for break-even point. Break-even point is equal to fixed cost by contribution per unit. Break-even point rupees is equal to fixed cost by CS ratio is equal to the P unit selling price. Next slide. Cost volume profit. Cost volume profit analyzer CVP is something companies use to figure out how change in cost and volume affect their operating expenses and net of income. CVP works by comparing different relationships such as the cost of operating and producing goods, the amount of goods sold and profit it's generated from the sales of those goods. CVP analyze give companies strong insight into the profitability of their products or service. Cost volume price analysis is a way to find out how change in variable and fixed cost affect a firm's profit. Companies can use the formula result to see how many units they need to sell to break even, cover all costs, or reach a certain minimum profit margin. Thank you.
Cost volume profit analysis formula. The CVP formula can be used to calculate the sales volume needed to cover cost and break even. In the CVP break even sales volume formula as follows. Break even sales volume is equal to FC by CM, where FC is equal to fixed cost, CM is equal to contribution margin, where contribution margin is equal to sales minus variable cost. To use the above formula to find a company's target sales volume, simply add a target profit amount per unit to the fixed cost component of the formula. This allows you to solve for the target volume based on the assumptions used in the formula. Uses of CVP analysis. Many companies and accounting professionals use cost for volume profit analysis to make informed decisions about the product or services they sell. CVP analysis plays a larger role in managerial accounting than in financial accounting. Managerial accounting focuses on helping managers or those tasked with running businesses make smart, cost effective moves. Elements of CVP analysis. The three elements involved in CVP analysis are cost, which means the expenses involved in producing or selling a product or service, volume, which means the number of units produced in the case of a physical product or the amount of service sold, profit, which means the difference between the selling price of a product or service minus the cost to produce or provide it. Thank you.